With gold and silver hitting the levels we've seen in the last few months, the ATO is watching precious metals investors closer than ever in 2026. Most investors are about to hand over 50% more profit than they need to, simply because they're making one of these three avoidable tax mistakes. Today I'm going to show you exactly how to keep those gains in your pocket and not the tax man's. My name is Navar. I'm the founder of a portfolio analytics and tax reporting platform here in Australia. At Navexa, we see the back end of thousands of portfolios, and let me tell you, precious metals are some of the biggest tax leaks that we've seen. Because most people only think about the buy and the sell price of bullion and not the tax implications that come with it. I'm seeing a lot of investors who have made incredible gains over the last year, but they're flying blind into tax season coming up. And if you don't have a strategy for how you're going to report these trades, you're just going to leave a massive tip for the ATO. To understand why these mistakes are so dangerous right now, we've got to take a look at the roller coaster we've just been on. In the last 6 to 9 months, we've seen a massive repricing of precious metals. We watched gold smash through the $5,000 AUD price per ounce barrier in 2026. And if you've been holding since mid last year, you're likely sitting on 30 to 40% gains. But silver has been the real headache for people. It launched in late 2025 from $30 up towards 120 AUD before that historic 30% correction that we've just witnessed. Now, whether you were taking profit at the highs or you were forced to liquidate your position during the silver crash, you've triggered what the ATO like to call a CGT event. And because these moves were so violent and so fast, it means most investors' trade records are an absolute mess right now. And if you're relying on a mental note or a messy spreadsheet to track those trades, you're about to run into one of these three tax mistakes. Mistake number 1, not understanding parcels. So most physical investors, they buy a bunch of gold and they just see it as that. They've got a bunch of gold. But every single coin you purchased or bar or however you acquired it is its own tax parcel with its own price, its own fees, and its own dates that it happened. So if you've bought 5 different gold coins on 5 different dates for 5 different prices, you need to keep track of all that data. Because let's say we go to sell one of those coins, how do you calculate the capital gain? Which coin was it that you sold? What price was it? What was the fee? And was it over 12 months or not? These are the numbers that are really important to keep track of, because they're critical for calculating your tax position. Now the thing is, even with these 5 different coins, when you sell one, just because you bought that specific coin at a specific price doesn't mean that's the price you have to use for the capital gain. Because you might have 5 coins or 10 coins that you're selling, you can decide which cost base from which of the coins you're going to use to calculate the capital gain. Now, of course, once you do that, that cost base is gone and you only have what's remaining. But it means this coming tax season, if you've sold or you're planning to sell some of your physical gold, you have quite a bit of flexibility in how you do it. So let's look at an example. So if we take a look at this gold ETF here in Navexa, we can see that we've made a $23,000 gain over the last kind of year, which is awesome, but it only is awesome if we can keep a lot of it. So if we switch over to trades, you can see there's been 3 different buy parcels on 3 different dates for 3 different prices. And then we sold some today for $57.12. Now, how do you calculate the gain for this? So depending on which parcel we use here, will result in a very different capital gain. So if we look at the capital gains tax report here, you can see that it's correctly picked up our gold transaction and gives us a $5,085 gain. Now that's using FIFO. So if we go back here, that means it's using the first in, first out. So it's going to calculate that $57 versus 46, which makes it a gain. And that's why we have a capital gain. But if we change the strategy from FIFO to LIFO, which is last in, first out, you can see now that gold is now a capital loss of negative $1,980. And as you might know, you don't pay tax on a capital loss. You can use that loss to offset other gains. And in this example, the gold loss is offsetting the capital gains from here. Now, the reason this became a capital loss is because if we come back to our trades here, switching to LIFO means we're using the last in, first out. So the $57 price is now calculated against the $61 price. So because it's less, means it's a capital loss. Now, this works as well. You can manually allocate the parcel. So we might say we want to use that middle parcel and we're selling 500. So now we can manually allocate this to the middle parcel specifically. So now when we go back to the capital gains tax report, you can see gold is now a short-term capital gain because we manually allocated it to that middle parcel. So it just gives you that flexibility of choosing exactly the parcel you want depending on the tax outcome you're trying to achieve. Now remember, once you've depleted a parcel, it's gone. So the next time you sell some, you're going to have to sell from the other parcels. So keep that in mind when you're trying to minimize tax this year. You will eventually have to realize those bigger parcels later. Mistake number 2 is the CGT discount trap. With the recent price surges and volatility of things like gold and silver, people have been trading the ups and downs. But what they're missing is that in Australia, if you hold an investment for longer than 1 year, you get 50% off your capital gains. So if we bought gold at $1,000 and sold it for $3,000, we have made a $2,000 capital gain. But if we sold that within 6 months of buying it, we have to pay tax on the full $2,000 gain. But if you held that for over 12 months and made the same trade, that $2,000 gain becomes a $1,000 gain because you qualify for the 50% CGT discount. Now, a lot of investors don't factor the timing in when they make trades. They really focus on buying and what the price is and what the fees are and where they're going to buy it from and all of that. But then when it comes to selling, they either just click sell when they're selling the gold ETF, or they go in and sell it at ABC Bullion or wherever you've done it, and they don't actually think about the sell side of the equation. If you sell it 1 day short of 12 months, you're paying 50% more gain than you need to. And if you sell it 1 day later, you get a huge 50% savings on that capital gain. So it's really important to keep track of all the parcels. You might be sitting there just with one piece of gold. You bought it at one price, you sell it at another price. Very easy to calculate and very easy to keep track of whether you've had it for 12 months or not. But think if you've been buying gold over time, maybe you've been following a dollar cost averaging strategy and you bought a bit of gold every month for the last few years, you might be sitting on 36, 50 different pieces of gold, which are all their own different tax parcels. Now, it's really important you know which ones qualify for the CGT discount and which ones don't, because when it comes time to sell some of that gold, you can then factor that into the decision and get a huge saving on your tax bill. And this applies to physical gold, physical silver, and it applies to the gold or silver ETFs as well. They behave exactly the same. Parcels of shares or parcels of physical gold, doesn't matter what it is, behaves exactly the same. Mistake number 3 is failing to harvest losses. Now, a lot of investors don't understand this, but it is super important if you want to succeed at investing. And this particularly applies to precious metals. So if you've made a big gain on your gold and you've realized a $2,000 capital gain, you will have to pay tax on it. However, what a lot of investors don't understand is you can offset that gain or the loss from a different investment. So let's say in the recent run, you had bought gold and you had bought silver. As the silver price plummeted and you sold and potentially realized a loss, that loss can then be used to offset the gain from gold. And the cool thing is this applies across all investments. So let's say you had gold, silver, and some Bitcoin. As we know lately, the Bitcoin price has crashed. If you've sold out of that position, you can use the loss from the Bitcoin to offset the gain from the gold. And this also applies to shares as well. So you can use shares to offset crypto or to offset gold, or to offset the gold or silver can offset the shares. It all works together, which is why it's important not to just track performance of a single asset like gold in a vacuum. You need to look at it across your entire portfolio so you know what's running at a tax loss, what's running at a capital gain, and then you can make smarter decisions when you go to sell something. Because let's say you needed $10,000 cash for whatever, paying for a new car or wedding or whatever it is. You need to know, how do I get $10,000 cash out of my portfolio in the most tax effective way? Because it's great if you're making a really big gain, but if you don't keep much of that gain when you go to sell it, what was the point of investing it in the first place? So now you know the 3 common mistakes that trip people up, and you know how to avoid them. And it comes down to one thing, and it's making sure you're tracking the data correctly and you understand the tax implications of the trades you're making. Now, of course, I'm the founder of Novexus, so I'm going to recommend to use that. Link in the bio if you're interested. Either way, you might track it on a piece of paper for all I care, in a spreadsheet, whatever you do, you've got to keep accurate records so that when you go to make a decision, or you might even be forced into making a decision because you have to get some cash for something, everything is ready to go for you to make the smartest tax decision that you possibly can. As Warren Buffett says, the best way to avoid capital gains tax is to not sell your investments. But that isn't always possible. So when you have to, having your records good to go is the difference between a huge tax bill and half a tax bill potentially. So if you enjoyed that, check out our next video. See you in the next one.